So, an analyst named CatDaddy Crypto recently published a breakdown that, well, challenges the core assumptions most Bitcoin maximalists operate under. His thesis starts with a question that sounds simple but actually has pretty profound implications. What keeps proof-of-work miners operational, long-term? The answer is fee revenue, not block rewards. Those halve every 4 years and eventually approach zero. The sustainability of Bitcoin's security model depends entirely on transaction fees compensating miners for their energy expenditure and hardware investment. Here's where the argument gets uncomfortable for Bitcoin holders. As Lightning Network and other Layer 2 solutions capture more transaction volume, fewer fees flow back to miners on the base layer. That's the explicit purpose of Layer 2 infrastructure. Cheaper, faster transactions that don't clog the main chain. But CatDaddy Crypto identifies the paradox. Layer 2 adoption solves Bitcoin's scaling problem, while at the same time it actually undermines its long-term security model. Fewer transactions on the base layer means lower fee revenue. Lower fee revenue means miners operating on thinner margins. And, well, thinner margins mean less hash power securing the network. Now, combine that with another issue. Bitcoin's market cap is approaching levels where doubling every halving cycle becomes, well, mathematically improbable. We're talking about a scenario where a $2 trillion asset needs to become 4 trillion, then 8 trillion, then 16 trillion. At some point, the numbers just stop making sense relative to global wealth distribution. Kaspa approaches this entire problem from a different architectural foundation. The token runs on Blockdag, directed acyclic graph technology, instead of traditional linear blockchain. This isn't just technical jargon. It fundamentally changes how the network processes transactions and compensates miners. CatDaddy Crypto explains that Kaspa's structure produces blocks rapidly, multiple blocks per second, with extremely low fees. The network doesn't need massive fee spikes to keep miners profitable because transaction volume compensates through velocity rather than individual transaction cost. Think of it this way. Bitcoin charges $5 per transaction and processes just a few per second. Kaspa, on the other hand, charges fractions of a penny but processes hundreds of transactions per second. The cumulative fee revenue to miners could potentially match or even exceed Bitcoin's model without, pricing out everyday users. Hold up real quick. If this architectural comparison is opening your eyes to dynamics you hadn't considered, show some love with that like button. And if you're serious about understanding infrastructure plays before they explode, subscribe to TJ Crypto World right now. We're uncovering the projects that actually matter while everyone else chases meme coins. Alright, let's talk about the industrial initiative that changes everything. Here's where Kaspa's thesis transitions from theoretical to tangible. The Kaspa Industrial Initiative, KII, represents a consortium that allegedly spent a decade evaluating blockchain infrastructure for enterprise-scale energy sector payments. So, according to CatDaddy Crypto's research, the KII actually tested Bitcoin. It also tested Ethereum. And yeah, it evaluated every major proof-of-work and proof-of-stake system that's currently on the market. But here's the thing, none of them met all the requirements. Simultaneous high-speed processing, low transaction costs, decentralization, and proof-of-work level security. Honestly, nothing really fit the bill until Kaspa launched back in 2021. Now, energy companies, they operate on razor-thin margins, right? And they deal with massive transaction volumes every single day. These companies need settlement systems that can process thousands of payments per minute, and they can't afford to rack up significant fees that would just eat into their profitability. Traditional banking infrastructure does handle this, but it's, slow, expensive at scale, and always subject to intermediary control. So, Kaspa's Blockdag architecture can, at least in theory, process these transaction volumes at speeds that traditional blockchains just can't match. CatDaddy Crypto claims the KII is already working with the 50 largest energy companies around the world. And, get this, they plan to run billions in payment volume using a custom Layer 2 solution that's built right on top of Kaspa's base layer. Alright, here's the crucial mechanism. Every single transaction on that KII Layer 2 actually settles back to Kaspa's base layer. Those settlements, in turn, generate fees that flow directly to the miners. This creates a sustainable revenue stream that's independent of speculative retail trading, which is honestly a big deal. So, if the KII alone is able to generate enough settlement activity to keep miners profitable, Kaspa could achieve institutional-grade security without needing viral adoption or some massive price appreciation. The network then becomes self-sustaining through real-world utility instead of just speculative hype. This fundamentally differs from most crypto projects that rely entirely on retail trading volume to justify their existence. Kaspa would have a bedrock of enterprise demand providing baseline security regardless of market conditions. What makes this potentially defensible is the architectural uniqueness. You can't just fork Kaspa's code and replicate what the KII spent 10 years searching for. The Blockdag structure, the fair launch with no pre-mine or VC backing, the proof-of-work security model. These components took years to develop and integrate. Daddy Crypto positions this as Kaspa's competitive advantage. While other projects chase the next narrative or trend, Kaspa built infrastructure that solves a specific, high-value problem for an industry managing trillions in annual cash flow. So, the industrial initiative provides a foundation, but Kaspa's potential actually extends into retail applications through its developing Layer 2 ecosystem. Daddy Crypto highlights projects like Kasplex and Egra Labs as early examples of developers building on top of Kaspa's base layer. The architecture allows smart contract functionality, DeFi protocols, and even meme coin launches, all settling back to the main chain. This mirrors Ethereum's ecosystem approach, but with fundamentally different economics, where Ethereum's Layer 2s sometimes fragment liquidity and attention. Kaspa's structure funnels all settlement activity back to miners on the base layer. This is where Daddy Crypto's argument becomes, well, pretty provocative. He suggests Kaspa could achieve infinite scaling potential without sacrificing decentralization or miner compensation. The Blockdag structure processes parallel blocks rather than sequential ones, which at least in theory removes the throughput ceiling that constrains traditional blockchains. If accurate, this positions Kaspa as an infrastructure layer that could support global-scale applications without hitting the congestion and fee spike problems that, really plague Ethereum during high-demand periods. The analyst doesn't predict explosive short-term price action. His thesis focuses on gradual adoption across multiple vectors, enterprise settlement through KII, developer experimentation on Layer 2s, and eventual retail discovery once the infrastructure proves itself. Before we wrap this with my personal take, I need to see that engagement. If this deep dive into infrastructure and economics is giving you perspective others don't have, hit that like button right now. And for those who want analysis that focuses on fundamentals over hype, subscribe in the TJ Crypto world and join the most informed community in crypto. Alright, here's my honest assessment. I'll be straight with you. Daddy Crypto's analysis addresses legitimate structural concerns about Bitcoin's long-term miner incentive model. The Layer 2 paradox is real. Scaling solutions that reduce base layer fees do create tension with long-term security. Kaspa's Blockdag approach offers a theoretical solution by maintaining high transaction throughput on the base layer itself, keeping fee revenue flowing to miners without pricing out users. If the KII claims are accurate, that's enterprise validation in an industry where trust and reliability matter more than speculation. The fair launch with no VC backing also matters. Projects without insider allocations tend to build more authentic communities and avoid the pump-and-dump dynamics that plague VC-backed tokens. But let's, inject some skepticism here. Kaspa at just over 5 cents with these big claims about dominating crypto really requires, some extraordinary evidence. The KII partnership, for example, needs verification that goes way beyond just analyst commentary. And honestly, the Blockdag technology still needs to prove itself at scale, especially under adversarial conditions. Plus, the Layer 2 ecosystem, it still has to attract developers away from those established platforms like Ethereum and Solana. Those, honestly, are some massive hurdles. I mean, Bitcoin has 15 years of battle-tested security and, trillion-dollar institutional backing. Ethereum, it's got the largest developer community and probably the most robust DeFi ecosystem out there. So Kaspa, it needs to not just compete, but actually outperform on multiple dimensions and do it all at the same time. If you're intrigued by this thesis, the approach isn't just buying blindly at 6 cents and hoping for, moon missions. It's really about watching for those validation signals, like KII partnership announcements, Layer 2 ecosystem growth metrics, developer activity, and most importantly, actual transaction volume growth that's independent of price speculation. So, Kaspa doesn't need to replace Bitcoin to be valuable. Really, it just needs to carve out a sustainable niche where its architectural advantages actually matter. The energy sector application, that could be that niche. Alright, crypto fam, that's the complete breakdown of Kaspa's controversial thesis, the Bitcoin miner problem, the industrial initiative, the Blockdag architecture, and whether a 6-cent token could actually challenge established players. Massive appreciation to everyone who made it to the end. You're building edge through deep analysis, and honestly, that's the only sustainable advantage in this market. Before you go, check out my latest breakdown on a relevant topic where I dissect a really interesting hook. The community's been absolutely crushing it in the comments, and I think you'll find some serious value there. Drop your thoughts below. Is Kaspa a legitimate infrastructure play or just another narrative without substance? I read every comment, and your perspectives help shape future content. Until next time, this is TJ from TJ Crypto World reminding you, price tags don't determine value. Architecture, adoption, and solving real problems do. Stay sharp, stay skeptical, and never confuse speculation with investing.